Hello everyone, here is Gemini AI. You know, every business, from a tiny corner store to a massive global corporation, really runs on promises. Today we're going to zoom in on the short-term promises, the ones that pop up on a company's books and honestly tell you a ton about its financial health.
Yep, we are talking about current liabilities. And hey, let's forget the dense accounting jargon for a minute. Think of this as a simple list. It's all the bills and debts a company has to pay off, like right away. It's basically a snapshot of the immediate financial pressures they're under.
So before we even get to the current part, let's just back up and start with the basics. What in the world is a liability? Really, the easiest way to think about it is just as a promise. It's something a company has promised to pay or maybe provide in the future. Okay, now for the official textbook definition. A liability is a present obligation to transfer economic resources as a result of past transactions. Let's break that down because those words matter. Present obligation, that means the company owes it right now, today, and past transactions means something already happened that created this obligation. It didn't just appear out of thin air.
So it works like a little chain of events. First, you have a past transaction. Let's say a company buys a bunch of supplies on credit. Boom. That immediately creates a present obligation to pay the supplier. And that obligation gets settled in the future with a future sacrifice, which, let's be real, is usually just a cash payment. See that? It's a clear line: past, present, and future.
All right, now that we've got a handle on what a liability is in general, let's add that super important word back in: current. We're going to narrow our focus now from all the company's promises down to just the short-term ones.
And the official rule here is actually pretty simple. A liability is considered current if it's due within 1 year, or what's called the company's normal operating cycle. But honestly, for most businesses out there, this just means anything they have to pay off in the next 12 months. These are the bills that are right on the horizon, staring them down.
And in the real world, this stuff takes all sorts of forms. The most common one you'll see is accounts payable. That's just the money owed to suppliers. Then you've got obligations to the government, like sales taxes, and of course, a big one, payroll owed to employees. Oh, and here's a kind of interesting one: deferred revenue. Think about it like this. You pay for a magazine subscription upfront for a whole year. Well, now that publisher owes you magazines, right? That makes it their current liability.
Okay, let's make this really concrete with our first case study: sales tax. We've all paid it. But when you buy something and pay that tax, that money doesn't actually belong to the store. The company is really just acting as a middleman, you know? They're just holding on to that cash for the government. And that creates a classic current liability.
And in a place like Canada, this can get, well, a little complicated fast. You've got a federal tax, then you've got provincial taxes, and sometimes they're all combined into one. So the rates can swing wildly, from 5% in one province to nearly 15% in another. But here's the key. For the business that's collecting all this tax, the basic accounting principle is exactly the same no matter what the rate is. So, this brings up a really important question, right? When a company makes a sale, how does its accounting system actually separate the money it earned from the money it's just temporarily holding for the government?
Well, here's how they do it. Let's take a simple $10,000 sale. The company might actually collect over $11,000 in cash from the customer. But, and this is crucial, it only records the $10,000 as its own sales revenue. All the rest, that tax portion, gets immediately funneled into a separate liability account, something called sales tax payable. This creates like a digital firewall between the company's money and the government's money. Super important.
All right, now for an even more complex and honestly fascinating example: payroll. This isn't just one simple liability. Oh no, it's a whole web of promises a company makes every single time it pays its employees. Think about an employee's paycheck. It starts out as this nice big number called gross pay, but on its journey to their bank account, it shrinks. Money gets deducted for taxes, for pensions, for insurance, you name it, leaving the final net pay. And for the company, every single one of those deductions represents a brand new liability. It's money they now owe to all these different government agencies and organizations, all on behalf of their employee.
So let's actually walk through the accounting, step by step. The whole process kicks off by recording the entire employee payroll expense, even the parts the employee will never actually see in their bank account.
So, imagine a $100,000 payroll. The first thing the company does is record that full amount as a business expense. Then, it creates a whole list of liabilities for everything it withheld: pension contributions, employment insurance, income tax, all of it. And what's left over at the very bottom? That's the salaries payable. That is the actual take-home pay owed directly to the employees.
But wait, the costs don't stop there. On top of the employee's gross pay, the company has its own set of payroll expenses it has to account for. And this is the second, really crucial step.
This leads to a whole second entry for something called employee benefits expense. This is the often hidden cost of having employees. It covers the company's own contributions to things like pension plans, insurance, workers' comp, and guess what? Each of these items also creates a separate payable, yet another promise the company has to fulfill.
Okay, the final step in this whole dance is actually the simplest one: paying the employees. This is where the company finally makes good on its direct promise to its workers.
The accounting here is nice and clean. That salaries payable liability we talked about, it gets cleared from the books, and the company's cash balance goes down by the exact same amount. This entry is the digital record of that moment money finally moves from the company's account into the employee's hands.
So far, everything we've talked about has been pretty clear-cut, right? Liabilities with the amount and the due date are known. But what happens when they're not? What about the maybe promises? This, my friends, is where accounting gets really, really interesting.
I mean, on one hand, you've got these super certain liabilities, like a supplier invoice. You know exactly who to pay, you know when it's due, and you know how much. But on the other hand, you have these murky liabilities where the who, the when, or the how much are all just big question marks.
The official accounting term for these uncertain liabilities is provisions. Now, a company can't just record any old maybe. There are two key tests it has to pass. First, the future payment has to be probable, which just means it's more likely than not to happen. And second, you have to be able to make a reliable estimate of the amount. If you can check both of those boxes, you absolutely have to record it as a liability.
A perfect classic example of a provision is a product warranty. Think about it. A company knows that when it sells 1,000 new laptops, a certain percentage of them are going to need repairs. So they have a present obligation from all those past sales, and they can use history to reliably estimate the future cost. They just don't know which specific laptops are going to break. It's that uncertainty that leads them to create a liability called a warranty provision.
So when it comes right down to it, handling all this uncertainty comes down to a really clear framework. It's all based on two questions. How likely is the payment, and can you reliably estimate the amount? If the answer is probable and yes, it goes on the books as a liability. If not, maybe it just gets a mention in a footnote somewhere. And this framework is what brings discipline to the world of financial maybes, which it really leaves us with a critical question to think about, doesn't it? When you look at a company, how much of its future is defined not by the promises it has already recorded, but by all the uncertain ones that it hasn't?